Okay. Okay, so let's continue with our questions. We are solving questions on IFRS 15, right? So this is a question and answer session of IFRS 16, right? In the previous video, we solved question 14, okay, which we said had everything, some all the elements. We looked at that. We looked at question 12 as well, right? Let's look at question 11. Then we went touch on some areas. We'll go and look at question 5, which also has some element of financing elements. And then we'll also look at where additional plant was purchased in a contract, right? So let's look at these things and then we'll finally draw the curtains on the question and answer session and then be officially or formally done with IFRS 15, right? Then we'll look at or we'll take under standard. Okay, so let's look at question 11 here. So let's look at question 11. Okay, it says below. So question 11 says below are the details of two contracts in the Graft PLC. Below are the details of two contracts in the Graft PLC. We have Oxy and Oge, OXY and AUGE. Right? We have their total revenue. We have cost to date, cost to complete, amount invoiced, and received. The entity measures satisfaction of performance obligation based on percentage of work certified as complete. So what are they telling us? They are telling us that they are using the output method, that's work certified as complete. So they are using the output method. And the requirement is what? Required. Prepare extract of the statement of profit or loss and other comprehensive income and the statement of financial position for each contract, assuming they are both A, 40% complete, and B, 36% complete, right? So here we have two contracts, Oxy and Oge, and then A is we have to use progress of 40% and B, progress of 36%. So progress has been given already. Don't waste your time to compute the progress. They said we should use this progress. Right, so let's start with, so I'm going to solve A, we are going to solve A, and then you try the B alone, and then you give me your answer in the comment section, right? So let's take A. It says we should assume that the project is what? 40% complete. 40% what? Complete. Okay, so question 11, let's take them one by one. So let's do Oxy first. Okay, let's take Oxy first. Then when we are done with Oxy, we'll come and look at Oge. Okay, so Oxy, we said the first thing to do is we have to check if there's overall profit or loss. So overall profit or loss, and that is, we said is a contract price. What's the total contract price? The total contract price for Oxy is what? 6,000. So we have 6,000 as the total contract what? Price, right? So we have what? 6,000. Let's look at total cost for Oxy. Total cost. The total cost is cost to date plus cost to what? Complete. So what's that cost to date? 1,800. Cost to complete is 2,000 what? 700. So 1,800 plus 2,700, we should give us something like 4,500. Okay. So if I hope I'm right, 4,500. So we deduct and then we have the profit. Here there's no profit, so there's no on-loss contract. So there's a profit of what? 1,000 what? 500. Step 2 is we have to compute what we call the progress. Okay. And we said progress has already been given to us. Okay. Here they said the question gave us progress, right, of 40% E. The question said progress is 40%. Okay. It's here. It says we should assume that the progress is what? 40% complete. So we have the progress. Then We are going to step three. Step three is our profit or loss account, right? So step three, we are going to P&L. How much do we record in our as revenue, and how much do we record as cost of what? Sales. I'm following. So we said with revenue, we pick the progress percent, that's 40% of 40% of the total contract price. What's the total contract price? 6,000. So we pick 40% of 6,000. Okay. 40% of 6,000. And then that should give us 40% of 6,000 should give us 2,400. So 2,000 was 400. And then cost of sales. We said cost of sales, we use cost to what date. So what's our cost to date with the Oxy? Cost to date is what? 1,800. So minus 1,000 what? 800. And then we are going to have a profit. Here too, there's a profit, right? So we have a profit of how much? A profit of 600, right? A profit of 600. So this is the profit that will be recording a profit of what? 600. Then we go to statement of financial position. That's 4. We go to the statement of financial position. What do we record there? So there we said we record contract asset or contract liability. And how do we get the contract asset or liability? We said revenue recognized to date. So revenue to date. Okay. And here too, this is the first time that we are recording revenue. There's no previous revenue recognized. This is like the one, like unlike the one we solved, where we had a previous revenue recognized. And so we have to deduct. Yeah, revenue recognized. The revenue recognized is the one that we are going to pick in the P&L, right? Which is 2,000 what? 400 revenue to date, and then amount billed. How much did we bill the customer? It's in the question. Amount billed and invoiced. Invoice is what? So we invoiced the customer. So this is amount invoiced and received. So we invoiced the customer 22,320 and received the same amount. That's why it is amount invoiced and received. So here, contract assets. Do you have an asset? Yes, contract asset of AT. So there's a contract asset of what? AT. And this contract asset here will go to statement of financial position as a current asset. We have current asset of what? AT. Okay. We are not going to have contract receivable or payable because amount billed is the same amount what received. So there's no contract asset or contract what liability. So this is how we go about the Oxy. Very simple. Just follow the steps. First of all, overall profit or loss. 2, progress. Here, progress has been given the question. Then the revenue, you apply the progress on the total contract price. So 40% on the 6,000. And we get 2,400. Cost of sales is the same as the cost to date, which is the question here. 1,800 deduct. We have profit of what? 600. So the 600 is what we are going to record as profit. Then of final position, revenue to date, which is what? 2,400. That's the revenue we've got in the P&L because this is the first time. And then we less amount billed. Let's go and look at, we are still looking at A. A says we use 40% progress. So let's go and look at okay. So with okay, so let's follow the formalities. I mean the step. So the first one is overall profit or what? Loss. Overall profit or loss. Okay, how do we get it? We said we bring the contract price. Okay, contract price. How much the contract price for okay? So we are back here. Okay, contract price is also 6,000. So we record contract price of what? 6,000. Then total cost. Total cost is cost to date plus cost to complete. Cost to date is what? 300. 3,000. Cost to complete is what? 4,500. So when you add the two, we have 7,500 as the total cost. right? So you see that with this one, when you deduct, are you following? When you deduct, we are going to have a loss, overall loss. Are you following? So we have overall contract loss of how much? 1,500. So we have a loss of 1,000 what? 500. 1,500 as overall loss. And the standard says we have to record the overall loss immediately. That's what the standard says. If we have a loss, we have to record the loss immediately, right? We have to record all the loss immediately. So we're going to record the 1,500 loss, 1,500 loss in the P&L. We'll record all. Step 2 is the progress. Okay. Step 2 is we get what the progress, which we said the question give us the progress to be what? 40%. Since we should assume it's 40% complete, that's for A. Then step 3 is our profit or loss account, right? Let's go to our P&L account. Revenue. How much revenue do you record? We said the revenue to be recognized is equal to your progress rate, that's the 40%, by your total contract price, 6,000, right? So 40% of 6,000, which gives us 2,400. Then our cost of sales, and we said the cost of sales is the same as the cost to date. So let's go to okay. What's our cost to date? The cost to date is what? 3,000, right? So when you come to okay, cost of sales is what? 3,000. So we record 3,000 here. So let's deduct and check something. 2,400 minus 3,000. We have a loss of what? 6,000, right? We have a loss of, 600. Are you following? We have a loss of 600. That is 2,400 minus what? 3,600. But if you look at the overall loss here, if you look at the overall loss is what? 1,500. But here, 2,400 minus 3,000, we said it will give us what? 600. And the say we should record the overall loss once immediately, right? So we have to record extra loss. Are you following? We've solved this before. We've solved similar ones. The same thing. We said if we deduct this alone, 2,400 minus 3,000, we'll get 600 loss. But the total loss is what? 1,500. So we have to record extra loss. Extra loss of how much? 900. Are you following? So that now, if you record extra loss of what? 900, 900 plus the loss that we recorded plus the 600 will give us 1,000 what? 500. So we have to record extra loss. Okay. We have to record extra what? Loss. Extra loss of what? 900. So that our overall loss now, or our loss that we are going to record in our P&L now, will be the 1,500. Okay, so if there's overall loss, this is how we do it. We normally recognize extra loss. Okay, we record extra what? Loss. That will help us record the whole loss. So that's it. So we need to record extra loss of 900 so that our total loss become 1,500. So the 900 is the difference. Okay. Then step 4, we go to step 4, we go to our statement of financial position. Okay. Step 4, we go to statement of financial position. So with step 4, in our statement of financial position, we have to record contract asset or liability. How do we record it? It is revenue recognized. What's the revenue recognized to date? It's 2,400. And I said it's to date. In this example, it's cool. It's the same. So it's fine. 2,400. And then amount billed. So amount billed is how much? How much did we bill the customer? This year, amount invoice and received, which is 2,000, 2,320. Okay, 3,320. So I think the difference between this and this should give us what? 80. Okay, so 80 is a contract asset. So contract asset of how much? 80. 80. So that's all. We are done. Contract asset of ET. That we're going to record in our books. And then the same financial position, don't forget we have liability. Don't forget provision. So you also have to bring it to financial position. Okay, we had the extra loss. There's a provision of how much? 900. The extra loss we recorded. So this also come to financial position as current liability. This figure here. The 900 extra loss that we recorded here. That's the 900 loss we recorded here. The extra loss. Okay, so that is that. If there's onerous contract, you have to record all the loss once. So sometimes you have to bring a difference that will clear the loss. And that's what we call the extra loss or the provision for onerous contract, right? So that's question 11. This is A. With B, they are doing the same thing, but we are using progress of what? 36%. It's the same thing that we've done. The only thing you do is you change the 40% to what? 60%. You change the 40% to change the 40% to 36% in all. They used to solve. So 40 to 36, that's all. So B, the same thing, but it's 30 what? 6%. So try the B and let me have your answers. You can drop them down. Okay, that's it. Let's look at question 10. Okay, I'll come and explain question 10 to you. We saw question 9 in the main video. Question 8, we saw it in the main video. Okay, I mean, in the normal Ifrs 15, I mean the main video, not the question and answer session, the main video. But the only difference is that here the margin was, in that one we had a markup, but here we have what? A margin. So it's the same thing. Okay. So you can refer to, I think it's in part 3, 4, if I'm right. Oh no, it's in part 2 or 3 of the main Ifrs 15 video. So you can check that for the solution here. The only thing is markup has been changed to margin. Okay. And then we said with this one, we have to change the margin to markup before we apply it on the cost here. Okay. So change the margin to markup and then you apply it on the 40,000. Well, let's see if there's let's solve the rest and see if there's time. We'll come back and look at it. But I want us to look at question 5. Very important. So let's look at question 5. Right? Okay, so question 5. Jadam Limited. So we have question 5. Okay. So question 5 says on 1st January 2019, Jadam signed a contract to supply 500,000 units of food packs at an agreed price of what? 20 cedis per unit. On the same day, 300,000 units were delivered with the remainder, right? With the remainder delivered on 1st June 2019. It was agreed that the customer would have extended, right, credit terms of 12 months from the date of delivery. Jadam's cost of capital is what? 10%. A new intent of the entity is not sure how to record the transaction. Year end is 31st May 2019. You are required explain to the intent how the transaction should be accounted for, and then I pass journal entries to give effect to the transaction for the year ended 31st May 2019. So let's look at something. Look at the year end. Year end is 31st May 2019. I following. Year end is 31st May 20 what? 19. That's the year end. 31st May 20 what? 19. Now, the contract happened on 1st January 2019 and is to supply 500,000 units, right, of food pack at 20 cedis per unit. They delivered 300,000 on the same day, and they delivered the remaining 200,000 on 1st June 2019. Right. So if you look at this, the 200,000 units for the 300,000, it was delivered within the reporting period immediately. But if you look at the 200,000, the remainder, right, the remainder, the 200,000, it was delivered on 1st June 2019. And 1st June 2019 is not, it's not in the accounting period, like it's not in the financial year. It's outside, it's in the following year. Because the year end is what? 31st May 2019. Are you following? The year end is 31st May 2019. And they delivered the remainder on 1st June 2019. So they did it outside the year. Are you following? So for the year ended 31st May 2019, we are going to record revenue for only the 300,000, not the whole 500,000. With the 300,000, it was delivered within accounting year. It was delivered the same time. So we say performance obligations was satisfied. But the 200,000, it was delivered on 1st June 2019, which is outside the period, the accounting period, which is outside the year end. The year end is 31st May, and they delivered it when? 1st June. So we record revenue for the 200,000 in the following accounting year. I following record revenue for the 200,000 in June 2019, which will be the following accounting what year, or the following reporting what period. I following. So that's it. That's the technicality here. And then also with the 300,000 units sold, they said they've what? Extended the credit terms, meaning that they will not receive the whole amount now, but the amount will be received in what? To be received in 12 months what time? The amount will be received in what? 12 months time. Are you following? So they have extended credit terms of what? 12 months. So when we multiply and we get the revenue to recognize, right? What we are going to do is we are not going to record all. We have to discount it to what? Present value. Are you following? Because they will receive the money in 12 months' time. They've extended the credit term, so they receive it in what? 12 months' time, which we have to discount to present value. Are you following? So that's all about the question. We are going to record revenue for only the 300 because performance obligation satisfied for the 300. The 200, it will be recorded the following accounting year, not for the year ended 31st May 2019. So very, very simple. So here we will say, okay, total revenue, or let's say something like contract price. Okay, it depends on how you do it, or we can even say sales. So our sales is for the 300,000, right? Times how much is per pack, 20 cities, right? You multiply, and this gives us what? 6 million. So 6 million Ghana cedis is the sales we've made. I said with the remaining 200, we are not going to record revenue because it will be in the following accounting year. Now, this 6 million, we should have just recorded the 6 million as revenue, but they will receive this 6 million in 12 months' time. It's a year or more. So I said whenever we receive an amount of money or we pay in a year's time or more, we have to discount to present value. If we were to be like 11 months, 9 months, we wouldn't have discounted. So we have to discount it to present what value, because to be received in a year's time. So present value, as I hope you know the present value formula, right? Our present value is the future value. Okay. So our present value, if you want, okay, we said the present value is what? The future value divided by 1 plus R, or raised to the power what? N. Are you following? So that's it. Very, very simple. So we have to discount it to present value. So how do we discount it to present value? It will be the future value, that's the 6 million. Okay, so you let me write here. So it will be the 6 million divided by 1 plus R is the cost of capital, 0.1, 10%, raised to the power what? It's only 1 year. Are you following? So that is it. And then this one will give you a figure of 5,454,545.45. So that's what we are going to have as the present value, 0.45. So these are revenue. I follow. So with this one, you debit revenue. Sorry, you debit and credit. Now we'll credit revenue. Okay. So with this one, we are going to credit what? Revenue with this figure, and then we will debit receivables. I following. So when you come here, what do? The entries will be, we will debit and then we'll do what? We will credit. So we credit revenue, okay, with the amount, the 5,454, 545 point what? 45. So we'll credit revenue, okay, and we'll debit receivable. Don't forget, we've not received the money yet. Are you following? We've not received the money yet, so the corresponding will be receivable. Okay, that'll be the corresponding entry, which is the debit entry. So the debit entry will be to debit receivable. Okay, so that's how we look at these things. We record revenue of 5,454,500 and what? 45.55. Is it 0.55 or 0.45? I think okay, 0.45. Right. So the roundings, so it's the present value that we are going to record as revenue, not the whole 600 the 6 million, right? Then at the year end, this is the very day. This entry here is as at inception, day one. At the year end, we do what we call unwounding, right? We compute what we call the finance income. So we have to unwound. The unwounding, how do you do it? It's the 10%. Okay. So we apply the 10%, I following, on it will be the 10% on the present value. That's the revenue. On the what? The present value. I following. That's what we do to get the finance what? Income. And that will be equal to 545,000 454.55. Okay, so this is what we are going to record as our finance what? Income. And this we are going to record it as other income or finance income when we go to our final accounts. Okay, so we are going to record the finance income as other income or finance income in the profit or loss what? Account as income, other income, but the revenue stays at the present value. Are you following? So with this figure here, what will be the entry? We will debit receivable again. This time we are not going to credit revenue, we are going to credit other income. Okay, so we'll credit other income. We'll credit what? Other income. Okay, credit other income. How much? It's 545,454.55. I'm right. And then we'll debit receivables again. Okay, we'll debit receivables. Okay, with the same amount. So do you realize that at the year end, the receivable figure will be 2? Okay, because check, we debited receivables here. We debited receivables here. Okay, and here too we are debiting what? Receivables. So if you like add the two, this one here plus this one, it will give you exactly the 6 million. Are you following? So this is how we go about questions like this. This is how we go about questions like this. Okay, so that's how we look at this. Okay, the finance income here, we said we take it to other what? Income. And we said at the end, if you add the receivable, if you add this opening receivable, this debit here plus this debit, to give you what? The 6 million. Okay, so note that we don't record the whole 6 million as revenue, even though we sold goods worth 6 million. We said whenever an amount of money will be received in a year's time or more, there's what we call a financing element, and it should be discounted to present what? Value. So we discounted the 6 million to present value, and then the 5,454,000 is what we are going to record as revenue. So we debited receivable and credited what? Revenue. And we said whenever we discount any amount to present value, we have to unwound. We either get finance income or finance cost. Right here it's receivable, so we get finance income. So we apply the 10% on the present value, and that's the finance income. And with the finance income, we say we credit other income and we debit receivables. So that's how we go about this question. That's how we go about this question. So what I've said is what you thought in 10. For the 200,000, we said we are not going to record it now. We'll record it when the performance obligation is what satisfied, right? Okay. Let's look at question. Well, is it question minute? Okay, there's another question which we have to solve, which is a bit, it's not that technical though, but it has an element of purchase there. Okay, it has an element of purchase in it. So we have to try it. It's similar to this question 4. Yeah. Okay. So let me go back here and try this because we're going to try one question. Yeah. Okay, I think it's this question. Okay. It's the same. I hope it's the same as this one. Let me check. Okay. So the same as this question 4. So let's solve it. The AME question here is the same as the one in the slide that we promised to what solved, right? We promised to solve. That we promised to what solve. So let's solve it. Okay. So we have question 4. So it says on 1st January 2021, AME entered into a contract with a customer to construct a stadium for a consideration of what? 1 million. The contract was expected to take 2 years to complete. At the 1st December 2021, AME had incurred cost of what 21 million. So we know that would be what? A cost to what date? Cost to complete are estimated at what? 20 million. Cost to complete. In addition to these, AME purchased plant to be used on the contract at a cost of what? 16 million. So they've incurred another cost again. Are you following? So they purchase, we had a cost to complete and cost to what date, but they purchase plant, meaning that they've incurred further cost. This plant was purchased on 1st January 2021 and will have no residual value at the end of the 2-year contract. Depreciation of the plant is allocated on a straight line basis across the contract. AME measures progress on the contract using an output method based on the value of work certified to date. At 31st December 2021, the value of work certified was what? 45 million, and the customer had paid 11.4 million. How should a transaction be accounted for? In the year ended 31st December 2021. So with this question, okay, the only difference or the only complication is not even complication. Is you see, we had our normal cost to date. So let's check. What was the cost to date in the question? Okay, at 31st December, AME had incurred cost of 24. So cost to date is what? 24 million. Are you following? Okay. And then cost to complete. The cost to complete was 20 million. That has also been stated in the question, right? Cost to complete was also what? 20 million. Okay. But they purchase a plant. What is the plant purchase? Okay. So if you look at the cost of the plant, the purchase plant, what's the cost of plant? 60 million. So the only complication is here is that aside the normal cost to date and the cost to complete, the purchase plant, what do we do? This plant, we have to spread it, or we have to divide it and share it to cost to date and then cost to what complete. So we have to share it for what cost to date and cost to what complete. That's all. We share it based on depreciation. That's all. Are you following? So we have the cost to date in the question, we have cost to complete, and they purchase additional plant. They purchase what? Plant to be used for the contract at the value of 60 million. So this $60 million, share it to cost to date and then to cost to what? Complete. So share it between cost to date and cost to what? Complete. How do we share? We share using the depreciation. Are you following? So check something. When was it purchased? 1st January 2021. And it says the useful life is what? 2 years. Are you following? So your depreciation, check. Your depreciation here will be 60 million divided by what? The 2 years. What do we get? 8 million. Are you following? So as at 31st December 2021, are you following? As at 31st December 2020, what? 1. The extract is here. This is 2021. Okay. It's 2020 what? 1. So as at 31st December 2020 what? 1. We have charged depreciation of what? 8 million. Because we purchased it in 1st June 2021. So as at 31st December 2021, when we are paying the extract, we've charged depreciation of what? 8 million. That depreciation of 8 million should be added to what? Cost to date. Are you following? Because we purchased it in 1st January 2021. Are you following? And we are now at 31st December 2021. So the depreciation for the 1 year from January 2021 to December 2021 will be added to what? Cost to what date? Because it was incurred. We used the plant from January to when? December, like we used it, so we have to add a depreciation for that 1 year. We give it to what? Cost to date. And then the remaining carrying value, the 16 million minus the 8 million, the remaining carrying value will be added to cost to what? Complete. Are you following? So depreciation is 8 million. We will add the depreciation to the cost to date. And then the carrying value, which will also be what? 8 million, should be added to what? Cost to what? Complete. That's all. That's what I'm saying. We have to share the cost of the plant to cost to date. We have shared for cost to date. We have to share for what? Cost to date and cost to complete. So now our cost to date now will now be what? The normal one, the 24 plus the depreciation. Are you following? The 24 plus the depreciation of 8 million charged, which will give us what? 32 million. So these are new cost to date. And then the cost to complete now will be the normal cost to complete in the question, 20 million plus the carrying value of the plant, 8 million. Are you following? Which should give us 28 million. That's all. So check. If we charge depreciation of 8 million and we give the depreciation of 8 million to cost to date, because we are at 31st December 2021, right? So we give the depreciation of 8 million to what? Cost to date. And then the carrying value, that's the 16 million minus the 8 million. That's the carrying value. We'll come and add it to what? Cost to what? Complete. So that's all. If we are done with this, fine, we are good to go. So from here, so the only complexity is just with the sharing the plant that we purchased. Okay, sharing the cost of that plant to the cost to date and cost to what? Complete. So we do the normal thing. Number one is overall overall profit or loss. And how do we do it? We said contract price. What is the contract price? The contract price is what? 100 million. Total cost. What's our total cost? It will be the new cost to date and cost to complete. So 32,000 plus what? 28, which is 60. So we have 60,000. And then we have a profit of, so there's overall profit of how much for, I'm sorry, yeah, overall profit of 40. Okay, overall profit of 40. Then step 2, we have to go and determine our what? Our progress. Okay, we have to get our progress. How do we get the progress? So our progress, we said is, here we are using the output method. We said is work certified over total contract price. It's in the question. They said they measure progress using the output method. Okay, so it's work certified divided by what? The contract price. Okay, by 100. So what is our work certified? It's in the question. Okay, the work certified is 45 million. It's here. So that will be 45 million divided by total contract price 100 million times 100%. And that will give us 45%. So 45% is the progress. 45% is the progress. Then we go to step 3 in our profit or loss P&L account revenue. How much revenue do we record? Is the contract price by the progress. So the progress 45% times what is the progress? Sorry, the contract price 1 million, 100. So the progress 45% by the total contract price 100. And what do we get? We will get 45 million as the revenue to recognize. Then cost of sales will be equal to, we said we just pick cost to date. So what's our cost to date? The new cost to date is what we are going to use here, not the old one. The old cost to date was what? 24. But after adding the depreciation, it becomes 32. Okay, so these are our new cost to date, 32. This figure here, this 32 is our new cost to what? Date. So we deduct the cost to date, 32,000. Okay. And then we are going to have something like 13, if I'm right. So we have a profit. Okay, we are going to have a profit of 13,000. So this 13 million, the 13 million is a profit. So that's a profit we have to record in our books, right? Then let's go to the statement of financial position. Okay, statement of financial position. So with the statement of financial position, okay, with the statement of financial position, we have contract asset or liability, right? So let me do that one down here. So statement of financial position, so we start with the contract asset. Contract asset, how do you do it? We pick revenue recognized. Revenue recognized, which is how much? How much revenue have we recognized? Then we can get in the P&L account. Okay, so revenue was 45 million. So we recorded revenue of what? 45 million. Then we less amount billed, right? It's in the question. So it says the customer had paid us 11.4. So less amount billed. How much is the amount billed? 11.4. So we have amount billed of what? 11.4 million. And then 45 minus 11.4 should give us a figure of, we should get a contract asset. So contract asset of 33.6, if I'm right, 33.6. So scan through if I've made any correction with the additions and summations, you can correct it. But the most important thing is you understand. Okay, so when you subtract, you get contract asset of this. Okay, and it's not only a contract asset that we are going to record, we also have to record PPE. Don't forget our PPE. Okay, it was at a cost of what? 60 million. Then depreciation that we added to cost to date was what? 8 million. So when you deduct, you have another what? 8 million left as PPE. Now we are bringing the 8 million left here because you see, we added the 8 million to cost of sales, the depreciation. Let me explain this to you so I get it. The depreciation of 8 million, okay, this depreciation of 8 million here was added to cost of sales, okay. We added this depreciation of 8 million to cost of sales, which we took to P&L as cost to date. Are you following? So the depreciation of 8 million, we added to what? Cost to date here. And we got this, and we took this one in the P&L as our cost to what? Date or cost of sales. But with the, come and check the cost to complete. The 8 million plant that we purchased here, this 8 million plant is the carrying value, right? That's the 60 million minus the 8 million depreciation, this 8 million here. Are you following? So this 8 million here, in the cost to complete, we didn't do anything with it. The cost to complete, we didn't do anything. Are you following? We didn't do anything with it. So we have to come and show it as the PP, the current value of the PP that we purchased, right? So this is how it is. Okay. So that's it with IFRS 15. We've solved so many questions. I think it's fine. We've gone through different areas of questions. There's one question which I would love to solve with you, but we will look at it along the line. Question 2. Question 2. Okay. Question 2, which is also a very nice question. I want to brush you through question 2. Okay. Okay. So let's look at this and then we call it yeah, then we draw the curtain. So let's go through question 2. I just want to explain fast, and then that'll be it. It's really a nice question that you have to look at. So question 2. Okay. This is Ellen charges 4 million, okay, for sale made on 31st September for a product which includes ongoing service for the next 2 years. The cost per annum to Ellen of providing that service is what? 300,000. The cost per annum. Ellen earns a gross margin of 20% on what? Such service. Ellen's year end is at 1st December. Explain how Ellen will account for what? The transaction. So in this question, we have 2 performance obligations, the sale of the good and then the ongoing what? Service. So we have to split it. Are you following? We have to split it. Look at the revenue that relates to the sale and then the revenue that relates to the ongoing what? Service. Are you following? The service, we've been given the cost of the service. So we have to get the standalone selling what? Price. Are you following? So we've been given cost. So we have to change the cost to what? Selling price. Are you following? So let's work on the service first. So with the service, okay, we know the total contract price is what? The 4 million. Are you following? That's the total contract price. But let's work on the service first. So we said the service will be given the cost. Are you following? So with the service, the cost of the service is 300,000, and it says per annum. So it will be 300,000 by 2. Don't forget they are doing it for 2 years. Are you following? Which will give us 600 what? Thousand. So this is the cost for the service. How do we get the selling price? Are you following? The selling price of the service. We said here we've been given a margin. A margin is not applied on what? Cost. Margin is applied on selling price. So we have to change the margin to markup. So if you want to change 20% margin to markup, okay, it will be 20 divided by what? 100 minus 20. You deduct the top 20 from the denominator. So it will be 20 all over 100 minus what? 20. And that will give you 1 out of 4. Are you following? So the margin will be 1 divided by what? 4. 1 over 4 times your cost. So we've changed the margin to markup. And that will give us what? 150,000. So we have profit of how much? 150. Are you following? So we have profit of what? 150,000. Okay. Now, So if you have profit of 150,000, if you add the profit to the cost, so now our selling price for the service is what? The cost 600 plus the 150, and that gives us what? 750. So this is the selling price for the service. Okay, it is 750,000. This is the selling price for the service. Okay, so now we know the standalone selling prices. We can come and do it now. So we said if the total contract price is what? 4 million. So let me write it here. Transaction price. So TP is what? 4 million. That's the total selling price, 4 million. So with this 4 million, let's show the breakdown. Okay. Service is taking the selling service is taking what? 750. That's the selling price. That's the standalone selling price. Then the remaining, okay, if out of the total transaction price here, if out of the 4 million, service is taking what? 750. Then the remaining is the one that should go to the goods. I follow it. So the goods will be, or the product. I follow it. So the product will be, so deduct, it will be the 4 million minus the 750. And what are we going to have? Okay, we are going to have 3,250,000. Right? You see that when you sum all, you come and get the 4 million. Are you following? When you sum all, you come and get the 4 million. So this is how we do it. When you sum all, you come and get your what? Your 4 million. You come and get your 4 what? Million. As simple as that. Then, how much do we record in our books? Okay, with the service, it is for 2 years. Don't forget that. We said with the product, we are going to record the whole 3,250,000, but with the service, is for what? 2 years. Okay, the service for 2 years. And look at when they happened. The transaction happened on 31st September. Okay, and the year end is what? 31st December. So we are going to record revenue for only 3 months. So September, October, November, what? December. So we are going to record revenue for only what? 3 months. So when you pick the service, okay, when you pick the service, we are not going to record the whole 750. So when you pick the service, we'll divide the 750,000. We said for 2 years. I following. Divide it by 2. And then we take 3 over what? 12 of it. I following. So with the service, we said we'll pick the 750,000. We divide by what? 2, because for 2 years. And look at where we are. We said we are in September. So we take only 3 months revenue. Okay. And we divide it by what? 2 times 3 over what? 12. That's how we're going to do it. The service for 2 years divided by 2, and we take 3 over 12. So we are not going to record the whole 3 million. Sorry, we are not going to record the whole 7 what? 50 for service. It's service, so it's like that performance obligation will be over what? Time. I following. So when you do this, 750,000 over 2 times 3 over what? 12, you get 93,750. So 93,750 is the amount of revenue that we are going to record for service. Are you following? So when you come here with the service, we are not going to record all the 750. We are going to record 93,750. But with the product, we are going to record all because we've sold it and performance obligation is satisfied. Are you following? So the total revenue that we are going to record will be the whole this figure here for the product. But for the service, the whole 3,250,000 for the product. But for the service, we are going to record only 93,750. The remaining will be what? A liability. Are you following? So the total revenue will be, as I said, the sum of the two. So our total revenue, okay, will be the one for the sale. This one, the 3,250,000. That'll be the 3,250,000 plus the service. We are not going to record the whole 750. We are going to record only 93,750. Are you following? And then the summation of the two should give us 3,343,750. 750. I hope I'm right with the additions. So that's how we are going to do it. So this is revenue we are going to record. Okay. We are going to record revenue of this, and then there will be a liability. Don't forget that the service, okay, the service was 750. That's the total service. It was 7 what 50. But we have recorded only 93 750. So the difference will be a liability. I following. So to be the liability will be the 750 for the service minus we recorded only what 93,750. And we have a liability of what 65,656 250 if I'm right. Hope I'm right. But just follow and get it. So that's how we're going to do it. It's very simple. It's similar to the one we solved. The only thing is that, okay, for the service, we have cost. When we give it a cost, you have to change the cost to selling price because the standalone selling what price. So 300 here is for a year, multiplied by 2, you get 600. So that's the cost. Then we change the margin to markup and we go 1/4. The 20% markup to margin, we go 1/4 what? Sorry, the 20% margin to markup rather. It was margin, so we change the margin to markup so that we can apply it on the cost. So we change the margin to markup. We go 1/4. We apply it on the 600, we go what? 150. So we add the profit to cost price, we get selling price. So the standalone selling price for the service, okay, is 750. The total transaction price is what? 4 million. So this is a division. Okay, so we deducted the 750 for the service from the total, and the remaining is what revenue and the product. So the product is 3,250,000. So this the revenue for the product. The service is what 750. But I'm saying that the service for 2 years, we are not going to record the whole 750 as revenue. That's why we came here. We divided the 750. That is 750. I following by 2 and multiply by 3/12 because September, October, November, what December, and this is it. So this is the revenue that we're going to record for the service. Then we add it to the revenue for the goods, and we have the total revenue. And then the liability for the service is the total service figure minus the revenue for service. And this is what we would have, right? So that is that. That's that for it. So I think revenue is fine. Let's draw the curtains on IFRS 15 revenue from contract with customers. So I'll see you in the next video.